Yes, the time has finally come. I've probably spent too much time researching stocks and I've done it. I've lost my mind because the easy wins are over, right? The profitable growing microcap stocks like Enterprise Group with great balance sheets, Gatekeeper Systems, Kraken Robotics, and industries that are growing absolutely massively. ADF Group up 600% in the past year. The easy wins are over. The good growth, profitable microcaps, everybody knows what they are now, so we have to go look for something different. And that leads me to today's craziness of looking at a SPAC. Yes, a special purpose acquisition stock. Most of these stocks are absolute dumpster fires. They have done tragically bad over the many, many years. This stock is absolutely no different. I will look at it in a minute and you can determine whether I have lost my mind, whether I am truly crazy, or whether I am a crazy genius. Because today I'm looking at Sabio Holdings, down 86% in 5 years, down 74% in 1 year, down 17% year to date. And I still see some potential in this company that I want to talk about. You're watching Common Sense Investing. My name is Cameron. Let's go find a great penny stock. And here's what I'm seeing with Sabio Holdings. Exponential revenue growth all the way up until the end of 2022. It was looking absolutely fantastic. In fact, revenue was higher than expenses for the last 2 quarters of 2022, so they were net income positive. All of a sudden, 2023 hits. What a dumpster fire of a year for this company. Revenue drops, expenses can't drop quite as quickly, and they go from being net income positive to actually losing money. When you go from the quarterly to the annually, doesn't look good, right? The revenue drop, and all of a sudden they go from, just about hitting profitability here full year 2022 to losing a pile of money in 2023. Not a great look, but I'm going to show you some things that might indicate that this is going to change. What does Sabio Holdings do? Ad tech solutions for the future of streaming TV. They have 4 different streams of revenue with Sabio, App Science, Vidillion, Sabio TV. I'm going to let the company tell you what they do here in this quick video.
The world of TV advertising is complicated. Not too long ago, there were only a few television channels people could watch. Running ads were simple because brands knew where to find the eyeballs. But now, traditional TV is becoming a thing of the past. And as people continue to cut the cord, brands know that streaming television and streaming apps are the future. But there are countless streaming apps people can watch, and on more devices than ever before. This makes it hard for brands to connect with the right audiences, on the right devices, on the right streaming apps. Sabio makes this easier. We built a completely unique analytics platform based on audience viewing behavior on mobile devices and streaming TV devices. Brands use this platform to better understand where their target audience is or watching content. This doesn't just help them find eyeballs, but allows brands to advertise to people who would actually want their product. So how does Sabio make money? When a brand pays Sabio to run advertising campaigns, some of those funds are used to run the ads, and Sabio keeps the rest as profit. Sabio helps brands understand their consumers, run effective advertising campaigns, and make the complicated world of advertising simple.
So Savio is saying they're connecting with a younger, more diverse crowd than typical cable TV. They're saying that the spend on this is going up by billions of dollars every year, and there's a huge market opportunity here. Here's their comparables in case you want to go take a look. But mostly I'm looking at this and seeing what can change. One of the things that's going to change this company in the short term is elections. The reason the revenue growth went from doing very, very well up until the end of 2022 and absolutely nosedived in 2023 was there was absolutely nothing to do with elections in 2023. No midterms, no nothing. So political elections are this company's bread and butter as a tiny little company. Now, one of the things to keep aware of here is that in 2024, guess what's coming up, right? More elections, more advertising, more spending on elections as the United States goes into election season. But look, that really doesn't interest me to get into a company that's going to be volatile every time there's an election. I'm a long-term coffee can type investor. I don't like that kind of stress. Which brings me to my main question of, What about the company without election revenue, right? If you take away the elections, is the base fundamental company improving or not? And that's what makes this slide so interesting. So they separate the years where they've had elections revenue. 2022 and their 42 million is over here on the right side, election year chart, non-election year chart. So they're saying they're getting this massive compounded annual growth rate of 86% on election years, and that's fantastic. However, they're saying their base company underneath is still getting CAGR of 37%. So when you look at the past couple years of Sabio, yes, they had 42 million here in 2022, and then everybody got scared off from this company because they had declining revenue down to 35 million. But that was due to the election year in 2022. They are saying that the base company underneath the election revenue is actually improving and that 2023 was a very successful year. Now they're going into another year, 2024, election year right here, which is going to be where? We don't know yet, but it could be quite big. Now, interestingly enough, 78% of revenue from repeat customers. So technically some recurring revenue here, 90% of retention of top 20 customers. So 18 out of 20 customers are re-signing with Sabio and they're getting a 24% increase in deal size. So when I take away this giant mess, I'm really concerned about what this company is doing on non-election years, and it's looking pretty good. And the company seems to recognize this as well because they're not highlighting any great election revenue or contracts. They are highlighting a recent partnership with McDonald's and Toyota, right? So McDonald's and Toyota's revenue is not going to be massively up and down like the election revenue will be. And that brings me back to what the company is doing, excluding the election revenue. And they're saying here that connected TV grew by 18% in 2023. So even though revenue was down in 2023 from 42 million to 35 million, it seems like the underlying business grew by at least 18%. That's something I can look at because I always say, let the company try to convince you to become a shareholder. If they can't do it, then nobody else can. They're saying high growth and profitable business. Despite the decline from 2022 to 2023, they think they're going to continue to grow, right? Reoccurring business model. They're saying their products are sticky, including 78% of revenues came from repeat customers. Now, interesting here, they say unique value proposition and strong moat. Where's the moat? Because there's a lot of businesses that do this type of work, and they're saying that basically their suite of technologies is giving them a moat compared to their competition. Go look at that yourself. Maybe we should get the company in for an interview to help describe this. Now, what are people paying for this company? Well, not a lot. If you get rid of EV over EBITDA and, of course, price to earnings, because 2023 was an absolute dumpster fire of a year. They weren't profitable. And you just look at price to sales or EV over revenue, this looks to be quite attractive. What's changed? Have they changed? I know that 2023 was bad. The company seems to recognize that 2023 was bad, but can they do something different in the future? Can they reduce this lumpiness every year of elections up and down? Can they grow the base company? Can they improve their balance sheet? Go take a look at their balance sheet. It's not great. They have some debt. There are some problems. One of the major things that I needed to point out here was as bad as 2023 was, and it was bad, right? Net loss, 4.7 million. Loss from operations of 3.7 million. This is for the full year of 2023. The last 3 months of 2023, Q4 actually had a net gain of 1.1 million and a net gain from operations of 1.4 million. So after losing a lot of money in the first 2 to 3 quarters of 2023, Q4 was actually quite positive for this company. Please keep in mind, this is not financial advice. This is just my opinion. I like making videos introducing these companies to good investors. I am not your financial advisor. I do not give buy, sell, or hold alerts. This is just my opinion as your average retail investor. And this again is what I'm talking about. 2023 adjusted EBITDA, negative 1.8 million. Q4 adjusted EBITDA, 2 million. In fact, it was only down about 300,000 from 2022, despite the revenue declining significantly. So full year 2023, bad. Q4 of 2023 really looking good. The company is saying, yeah, there was a decrease in revenue, but they made this money because there was a substantial offset through several cost and operational efficiency initiatives implemented during the second and third quarters of 2023. Normalized for commissions and bonuses, these initiatives resulted in a 23% reduction in fourth quarter operating expenses. Can this continue? Is this the new normal where Sabio Holdings is entering 2024, which should be a high revenue year with elections, and yet they've reduced their operating costs by 23%? Please go do your research. Let me know what you think of this stock, because this is just a quick introductory video. The risks and the rewards, again, in my opinion, and not financial advice, I think the risks are pretty clear here, right? Even if they succeed moving forward, there's going to be volatility. There's still a small company that's still getting a lot of revenue from elections advertising. So there's still going to be some years that are up and down a little more than others. But if you look at the underlying company, is it continuing to grow? That's what I'm worried about. The balance sheet, go take a look at the balance sheet. They have some debt. They have some convertible notes. It's definitely not perfect, right? It's a SPAC stock. It struggled for quite a while. Are they figuring things out? There's also a lot of assumptions here. You have to assume that the 23% reduction in expenses can continue moving forward. You have to assume that the 2024 growth is going to be quite large. You're going to have to assume that shareholders and investors still care about this company, right? Right now, the way share price is going down, even though they announced the 2024 contracts coming up, seems to me that not a lot of people are interested in Savio Holdings right now. But if you're willing to take the risk, high reward play, some of the reward here are potentially pretty big. The Q1 is incoming. That could reduce the risk. We get to see how much cash they have left. We get to see what 2024 could potentially look like. Q1 is typically their lowest revenue cycle quarter. So there's not a lot of risk going into it where revenue is going to shoot to the moon. It's typically their lowest quarter. Is it undervalued? There's not a lot of undervalued stocks left out there, right? There's a lot of stocks now that have gone up 100%, 200%. The easy wins have already been going up. So if you're looking at a beat up, undervalued, cheap stock, a SPAC is one way to do it. Has it been completely ignored? I'm looking at a company that seems to have changed. They have seemed to have cut their expenses. They're having growing revenue. I've had another stock like that recently in NTG Clarity Networks, where they announced fantastic news after fantastic news and nobody noticed until something happened, some inflection point, something changed where all of a sudden investors took notice. NTG Clarity Networks is up over 100% just in 2024. So I'm wondering if this company, Sabio Holdings, is at the same inflection point where people are mad at them. They're upset at the share price going down over the past couple of years. They don't want anything to do with this stock anymore, except underneath the company is improving. The fundamentals are improving. And if they can continue to produce and execute on what their plans are and reducing those expenses, growing that revenue, and they start showing profitability in 2024, can that be a change for shareholders? You've been watching Common Sense Investing. I really appreciate your time. Hope to see you again soon.